Greetings, my name is Christopher Bell, Certified Public Accountant. In this video, we're going to cover inventory accounting using the FIFO method, also known as first in, first out. Now, if you like me, you think I'm cool, and you want a one-on-one personalized accounting lesson to cover any accounting topic, there will be a pinned comment in the comment section below where you can sign up. Let's talk about this example. So there's two pictures right here. On the left, there's a picture of me, Christopher Bell, and on the right, there's a picture of a Pokemon card, specifically a Charizard. Now, Christopher is tired of being an accountant. It's boring and, he wants something new and exciting in his life. So he decided to get in the business of buying and selling Charizard cards. He's going to buy a bunch of Charizard cards, he's going to sell them for a higher price, and he's going to become a millionaire instantly. So he's decided that this is going to be his full-time job. Well, now he's got to decide a couple things. How am I going to account for this? Number one, the most important thing. How am I going to account for the profit and loss? What is my inventory expense? I don't know. Let's see some examples and work through the problems. So on March 1st, Chris buys 10 Charizard cards for $125 each with cash. How would Chris account for this? Well, if we do a journal entry, we put the date down, March 1st, and we say, okay, he spent $125 each and bought 10 cards. So we take 10, the number of cards, times 125, and that's how much inventory we have purchased. Why is it inventory? Because our intention is to buy it and then sell it at a higher price. It's accounted for as inventory on the balance sheet. So we debit inventory because we are increasing an asset by 1,250, which is... Sorry, I can't type here. 1,250, which is the total cost of the 10 Charizard cards that we bought. How much cash did we spend? Well, we spent the same amount in cash. And since we spent cash, we credit cash because it's leaving the business. And now we have our first journal entry. So I've even been nice enough, I was nice enough to my students, to make a nice chart over here to track our total costs. And when you're doing problems like this, I highly recommend you do something like this to track it. You want a date, number of cards, or number of inventory, cost per card, and total cost. That will make sure you do not forget something or leave something out, because if you do, you're going to get the problem wrong. So a couple days later, Chris sees another deal. He says, oh man, I just found 5 more Charizard cards on Facebook Marketplace. So he goes ahead and buys 5 more cards for $150 each. How much is that? Well, it's $750. So on March 4th, we record the journal entry of a debit to inventory for $750, and we credit cash for $750 because we bought it with cash. So now we have how much inventory? We have $2,000 of inventory. Now comes the selling transaction. We sold on March 9th 12 Charizard cards for $200 each. Looks like we got a profit, right? But we sold 12. Okay, so we have 15 total. So we sold 12. But which ones do we count? Do we count these, the 125 per card? Or do we count these? Do we count a combination of the two? Well, that's where the inventory methods come into place, okay? When you're using FIFO, you're doing first in, first out. You're assuming the inventory that came in first is the first inventory to leave. What did Chris buy first? Did he buy the 10 Charizard cards for $125 each? Or did he buy the 5 Charizard cards for $150 each? Yes, he bought the 10 Charizard cards for $125 each first, because it was on March 1st, which is before March 4th. So we know that we sold 12 cards. So the first 10, we've sold all of these. All of these are gone. So we're going to track the sale amount right here. So we sold 1,250 from batch 1. And then we still have how many cards to account for? We sold 10, so these 10 are gone. So we're going to cross this out. And then we sold how many from the second group? We sold 2. So there's 3 left. And we sold 2. So to calculate that, we say, okay, we sold 1,250 of inventory from the first batch, and we sold 2 additional cards from the second batch. We paid $150 per card, So 2 cards is a total of 300. So the cost of goods sold entry is going to be 1,250 plus 300 from batch 2 gives us a total of what? 1,550 of cost of goods sold. So now we can do the journal entries. Remember, in a sale, there's 2 transactions. There's the revenue transaction and the cost of goods sold transaction. We'll do the revenue first. So March 9th, we'll just say we sold it for cash. We sold 12 cards for 200 each. So we generated $2,400 in cash, and we generated $2,400 in revenue because that's what we sold it for. What is the cost of goods sold transaction? Well, we just calculated. So we debit cost of goods sold, which is inventory expense, for the number that we calculated over here, which is 1,550. 1,550. And we credit inventory for 1,550 because cost of goods sold is basically inventory expense. When you sell inventory on the date of sale, that's when you record the cost of goods sold expense and not a day before. So now we have our problem completed, right? Well, there's a couple more questions. The next question is, what is the ending inventory on March 31st, assuming no additional transactions? Well, our total inventory was what? We had 2,000 of inventory. So we had 2,000 at the beginning. And then we sold how much? We sold 1,550 was sold. So what is our ending inventory? Well, we take our trusty dusty calculator and we get $450 in ending inventory. Now, another way you could do this is you could just look on your chart and say, okay, I know I sold 10 of these. These are gone. First in, first out. Then I moved on to the next batch. I sold 2 of those, leaving 3. So what must be left is the 3 cards times 150 or 450. So we know we are good and we know we are right. So the answer is 450 in ending inventory. Now the last question is, the second to last question is, what is the gross profit for the month of March? What is gross profit? Gross profit is sales or revenue minus cost of goods sold, also known as cost of sales, equals gross profit. So we're going to take our revenue, which was $2,400, and we're going to subtract our cost of sales, which was what? $1,550. And that gives us our gross profit of $2,400 minus $1,550, $850 of gross profit. What is the gross profit margin? Well, the abridged formula is gross profit divided by sales. It's basically our profit percentage per sale. So that total is $850, which we just calculated. We take $850 and we divide it by $2,400. And that gives us what? $850 divided by $2,400, 35.42%. And that is our answer. So that is FIFO, okay? There's LIFO, there's average cost. There's all sorts of ways you can account for inventory. This is just one way to do it. Hopefully that makes sense. Hopefully you learned something. Like I said, if you want a one-on-one session, there'll be a pinned comment down below, and I'll talk to you soon.